Hi everyone, good morning. So today we'll be starting with discounted cash flow question and answers. So these are advanced question and answers. And previously we have discussed the discounted cash flow basic questions. So discounted cash flow advanced questions, these questions are more advanced and cover how you use a DCF in real time, in real life, and some of the complexities that arise when you are using it to value real companies. Most of these are more likely if you are experienced and are interviewing for investment banking or private equity positions. My name is Deepak Best, and let's get started. These are only 7 questions, and we will try to wrap these up with proper explanations as soon as possible. So let's get started. So first question here is explain why we would use the mid-year convention in a DCF. So what is a mid-year convention and why it's used in a DCF? So mid-year convention represents the fact that company's cash flow does not come 100% of company's cash flow at the this does not occurs at the end of the year. So instead, it comes evenly throughout the year. In a DCF without mid-year convention, we would use discounted periods numbered as 1 for year 1, 2 for year 2, and 3 for year 3. And with mid-year convention, we use instead of 1 to 3, we use 0.5, 1.5, and 2.5, which makes sense because we are assuming that throughout the year, we are averaging whatsoever cashes come in flow. We are averaging them out and we are using mid-year convention. This is what it means. And if we are using 1, 2, and 3, this means that at the end of the year, only your company is generating revenue, not throughout the year. So this is the more logical approach. And if you think about it, the mid-year convention is applied in DCF model to to more accurately reflect the timing of when cash flows are generated and received. In practical, companies do not generate 100% of their annual free cash flow at year end or December 31st. Rather, the cash flows are earned and realized incrementally throughout the years from operations. And from a valuation standpoint, this timing difference matters because the present value of a cash flow depends directly on when it is received. If we discount cash flow as if they occur at the end of each fiscal year, we effectively assume the company earns nothing until the year end, and this overstates the time value discount and significantly undervalues the firm. To adjust this, the mid-year convention assumes that each year's cash flow is received on average halfway through the year, and mathematically, this shifts the discounting period for each year back to zero point 0.5. So instead of discounting by period 1 to 3, we discount by 0 0.5, 1.5, 2.5, and so on. This adjustment increases the present value of future cash flows because it recognizes that cash is being generated earlier. This impact is more pronounced for companies with larger near-term cash flows and diminishes as you move further out in the forecast period. So overall, applying the mid-year convention improves the precision of a DCF by better aligning the model assumptions with the economic reality of cash flow timings. I hope you have understood what the mid-year convention is about in a DCF. And in question number 2 also, we will be discussing about mid-year convention only, but we will refer to our Excel where we have done a DCF. So let's move to question number 2 now. So here in question number 1, just understand this thing that mid-year conventions are used so that we are uh, when we are practically using a DCF, it makes more sense that throughout the year we were generating revenue from the operations. And if we are assuming that the revenue is generated at the year end, So that would be wrong. So discounting those numbers during the mid-year using the mid-year convention makes more sense and it's more practical. So previously also we have discussed that in theory and in practice there are different things. Don't get confused with mid-year convention and these kind of things. We will talk about this in detail when we will do a DCF valuation of a public company. And I will also tell you how we get the data and everything. So let's move to question number two for now. Right, here is question number two, which is asking what discount period, what discount period number should I use for a mid-year convention if I have a stub period? Example question, example quarter four of year one in my DCF. So what is a stub period? That's the first question. And in mid-year convention, how do we use this? So when a DCF includes a stub period, for instance, this analysis starts in quarter four of year one rather than at the beginning of the fiscal year. This is obvious because the timing of cash flows and the corresponding discount period must align to accurately reflect the mid-year convention. And this is majorly the case where you are starting your valuation in quarter two, three, or four. So it's not an year start activity. You can start your valuation anytime in throughout the year. So this is a stub period that represents the point 0.25 represents one quarter of the year. So if we talk about this, um, under a mid-year convention, we assume that each year's cash flows are received evenly throughout the year and occur on average halfway through the period. And therefore, instead of discounting one year's cash flow by one, we discount them by 0.5. And year two, we discount them by 1.5. And year three, we discount them by 2.5. And effectively shifting each period back to 0.5 to reflect average receipt times. And however, in a stub period, if an stub period exists, we need to recognize that the stub represent only a fraction of the full year. And to incorporate both the stub and the mid-year convention, we need to follow two key steps. We divide the stub period by two because under the mid-year assumption, the stub cash flow is assumed to be received halfway through that shorter stub period. So we are assuming that even if this is one quarter's number, we are assuming that we are getting the generating revenue in the mid using the mid-year convention, we are generating the revenue in the mid of this quarter. And we will subtract 0.5 from each subsequent full year discount to maintain a mid-year assumption for all subsequent periods. And for examples, suppose in quarter four of year one, if quarter four of year one represents 0.25 of a stub period, the normal discount period would look like this: 0.25, 1.25, 2.25, and 3.25, 4.25. Why I'm using 1.25? Why I'm using 2.25? Why I'm using 3.35? And why I'm using 4.25? Let me just show you. Okay, I will show you. Before that, let's talk about the calculation. When we adjust these calculations, we will divide the stub period by 2. So 0.25 we divided by 2 is 1.25. And we will shift these periods to make it mid-year convention. So we will shift it 1.25, we will subtract 0.5 and it will be shifted to 0.75, 1.75, 2.75, and 3.75. And this approach actually assures that the discounting aligns with the economic reality of when cash flows are earned. And even with a partial initial period, we also provide a smoother and more accurate presentation of time value, particularly in transaction or valuation context when the stub period can meaningfully impact present value calculation. So just remember this, divide the stub period by 2 and for future years, subtract 0.5. So let me just show you my Excel, which I have prepared. Um, okay, before that, let's look at the DCF calculation here, the screenshot which we discussed. Okay, so if you can see here, year fraction is 0.25. This is representing a stub period. The starting of the valuation started at the end of the quarter 3, 9/30/2017. So this is actually representing a stub period, but they have actually adjusted the calculations. They have taken they have adjusted these numbers. Okay, understand this thing. 1.25, I was discussing why. Okay, normal stub would be 0.25, 1.25, 2.25, 3.25, and 4.25. Let's discuss about normal stub. What is normal stub? If I'm discounting this to here, so I will be discounting it to 0.25 only. I will be discounting 4540 by 0.25 only at a rate of 1.25. The second quarter, I will be discounting 25,994 at a rate of 12% to 1.25, because see, I actually have to the present value, the present the today is actually 1 quarter and 1 year away. These numbers are 1 quarter and 1 year and 1 quarter away. So that's why the discounting factor in the normal period will be 1.25. This will be 2.25. This period we will be discounting it by 3.25, 4.25, 5.25. So uh, this was the normal and mid-year stub. Now understand this thing. What I have done is 1.25, I have subtracted 0.5 from that. Here also I have subtracted 0.5 from that. Here also I have subtracted 0.5 from that. So 0.25 is representing, if I divide it by 2, it will represent 1.25. So this will assume that we are following mid-year convention. So we are assuming that we have generated revenue not at 0.25 at the end of the quarter, but in between, in the middle of the quarter. And if I add these two numbers and subtract 0.5, this means that we are generating revenue in between these two time frames. So this is how effectively we are assuming. This is what we are actually assuming here, that we have generated revenue in the we have adjusted our stub period by dividing by 2. But the later on periods, we will actually have to subtract 0.25, sorry, 0.5 out of the normal period. So I have subtracted 0.5 from the normal period. So this is actually shifting the time frame in between these two, quarter 4 and year 2. It's shifting in some, but the timing is shifting in 0.75. Now we are discounting the numbers and we are assuming that we have generated revenue somewhat around in 0.75. So this is now making more sense. In practicality, this is making more sense. And this will be a drawback if you are a company which generates major of that revenue at the year end. Like you are a e-commerce company like Amazon, Flipkart, or others, and you are generating revenue at the end of the year, and there are also lucrative sales offers also at the end of the year. But even though it will cover all those things, I hope this was clear. Let me just show you. Okay, let's talk about all this in question number three. So I hope we have discussed you have understood how do we calculate the stub period, and this will be used in question number three. Or question number the data from question number one and question number two information which we are understanding here. It will be all the concept will be applied in question number three. So let's move to question number three. So question number three is how does the terminal value calculation changes when we use mid-year convention? So when you're discounting a terminal value back to the present value and you use different numbers for discounting periods depending on whether you are using multiple methods or Gordon growth methods. So using multiple method, you add zero point 0.5 of the final year discount numbers to reflect the fact that you are assuming the company gets sold at the end of the year. So Gordon growth method, you use final year's discount number as is because you are assuming the cash flow grow into perpetuity and uh, that they are still receiving throughout the year rather than at the end of the year. Let me just show you my Excel. Uh, okay, so this Excel I have created using these numbers. So in year 2017, it's 0.25 only. 2018 1, 19, 20, 21, 22, and there is the exit multiple 467. Okay, these are the numbers. Transaction free cash flow. So 4540, 4540, 25 30 34 38 41, 25 30 34 38 41, and the terminal value 467009. Terminal value is 467,009. We know that the discount rate was 12%. Okay, so here this was the year fraction. So nominal timing was 0.25, 1.25, 2.25, 3.25, 4.25, and 5.25. You're supposed to discount them back. But when we used mid-year convention, what we do is for the first quarter, for the first year, we divide it by 2. And for the later years, we will subtract 0.25. So now this is the mid-year adjusted discount time. Using this time, this was the cash flow. And using this time, I have calculated the discounting factor. And this is pretty much simple. So what I have done is I have divided 1.12. I have discounted 1.12 by 0.125 for the first year. I have discounted 1.12 by 0.75 for year 2. I have discounted 1.12 to the power 1.75 for year 3. If you can see the numbers, I have discounted 1.12 to the power 2.75. I have discounted again 1.12 to the power of 3.75, and I have discounted 1.12 to the power of 4.75. These are my discounting factors. So I will discount free cash flow with my discounting factor. I will discount this year's cash flow with my discounting factor for the year. So here I have calculated, I have divided free cash flow by the discounting factor. I have divided free cash flow by the discounting factor. So this I have divided. If you can see the formula here. And for my terminal value, I have adjusted my discounting factor. And why have I done that? The reason behind this is, see, if I were to calculate my the terminal value, I want a more precise number. So exact discounting period for terminal value should represent uh, perpetual cash flows starting from 2023. So this means that this time should be midpoint of 2017's quarter 4, and the other discounting periods. So if I add 0.25, now understand this thing very just pay attention. So this is what the first stub period, the 5 other periods. I have added zero point 0.5 and I have subtracted 0.125. So this is actually giving me the discounting factor 5.875, and that's what I've used here. Sorry, I actually have to subtract this thing. This I have subtracted. So I have used 5.625. So what it is this is the stub midpoint. This is the full year 18 to 22. I have added zero point 0.5 so that I can zero point 0.5 to for the terminal value to start, and I am then subtracted the stub adjustment. I have subtracted the adjustment. So whatsoever the adjustments were done here, I have subtracted those adjustments. This adjustment I have subtracted here, and because we were subtracting zero point 0.5, I have added subtract zero point 0.5. This is a little tricky. You will understand this in more better when we will do a DCF. So this, I hope this is making sense. This is when I calculated using my discounting period. I have discounted my discounting rate using this amount. So I have received this is a terminal value, and total present value would be the total enterprise value would be 374728, which is pretty much around 378. Okay, I think control tab doesn't works. But this is pretty much close to 378, 381, 378, 381, and this is 374, 728. So we are pretty much close to that only. So I hope this is clear now. Question number 3. Now we will discuss about this in more detail. How does terminal value calculation change when we use mid-year convention? And other questions. And when we will be discussing uh, a DCF in detail. So just understand this thing that when you're applying a mid-year convention in a DCF, you are recognizing that the free cash flows are generated evenly throughout the year rather than entirely at the year end. And this affects how we discount both interim cash flows and terminal value. The adjustment to the terminal value especially depends on the method used to calculate it, either the multiples or the Gordon growth method. So under the multiples method, the terminal value is based on an exit multiple of a financial metric in final projected years, and conceptually it represents the proceeds from selling the business at the end of the year. In Gordon growth or perpetuity growth method, terminal value represent the present value of all future cash flows beyond the projected period. So assuming they grow at a constant rate in perpetuity. And because if you think about this from the multiples method approach, since the sale occur at the year end, but the mid-year convention assumes the cash flows are received halfway through the year, so we must discount the terminal value back to an additional half year relative to the final year's cash flow. So that's why we have added zero point 0.5 previously, where the example which I just show you when in my Excel. So mathematically, the final projection year in if the financial projected year is year n, instead of discounting by n minus zero point 0.5, as we do for mid-year convention, we discount the terminal value by n years, effectively adding 0.5 to the discounting period to reflect the terminal value occurred slightly later in time. And if you think about it from Gordon growth method perspective, because these cash flows are conceptually occurring throughout each future year, the mid-year assumption already captures the timing of cash flow receipts, and therefore, when discounting a terminal value back to present, we use the same mid-year period as the final projected cash flows. So we do not add the extra 0.5. So in Gordon growth, we do not add, and in terminal, if we are using multiples method, we do add. So multiples method, we add 0.5 to a discounting period, and Gordon growth, we use the final year's mid year discounting period as it is. I hope after understanding the example or after looking at the Excel, this has actually made more sense to you guys. All right, so this covers our media convention things. Some of the dot topic, all these three questions were around media convention. I hope this covers everything. Let's move to question number four. The question number four is, if I am working with a public company in a DCF, how do I calculate its per share value? Okay, so this is actually around per share value. We understand that for per share value, we need to calculate the total shares outstanding, and also the enterprise and the equity value. Once we enterprise value, okay, let me just show you that one more time. The DCF. So what they are asking is the equity value per share, or how do you calculate per share value? So we have discussed this. So we once you get the enterprise value, you add back cash and you subtract debt, and you also subtract other debt-like items like preferred stock and non-controlling interest to get the equity value. Then you add, then you, okay, we have not discussed about circular calculations. So circular calculations, so after this, we take into circular calculations. And that takes into account the basic shares outstanding, options, warrants, and convertibles, and other dilutive securities. Circular means that dilution from these depends on per share prices, but the per share prices depend on the number of shares outstanding. So, which depends on the per share price. To resolve this, you need to enable iterative calculation in Excel so that it can cycle through to find an approximate per share price. So, what does that means is to calculate the per share price, iterative calculation here also, per share price, either your enterprise value changes or your total number of shares changes. In the Excel, if you are modifying it, you are doing modification. So if one of your variable changes, so it should not start uh, showing you an error. So iterative calculation uh, help enables that any of the plugin changes, it calculates itself by it actually calculates itself. So that's the circular reference. So once you have completed a DCF and derived enterprise value and bridged from enterprise value to equity value, since the per share value is ultimately based on company's equity, to do this, start with enterprise value, make a standard capital structure adjustment, uh, then calculate the equity value. After that, from just move to implied share value. To do that correctly, you will need to divide equity value by the fully diluted number of shares, and to calculate the fully number of diluted shares, it could be complex because it depends on capital structure and the company's outstanding convertible instruments that you actually have to consider. And for stock options and warrant, you use treasury stock method and you assume that the money in the options are exercised. The company receives cash from the exercise and then repurchase those shares at an implied price. And for convertible bonds and preferred stocks, you use if converted method, which assumes conversion only if it's economically beneficial. Economically beneficial means in the money, out of the money. We have discussed about that. Just watch those videos. In the money and out of the money. And the challenge is that the dilution itself depend on the per share price actually. But the per share price depends on the number of diluted shares and creating a circular reference. So this to resolve this circularity, we enable iterative calculation in Excel. This allows the model to iterate through the potential per share values until the share count and the price converge to a stable, internally consistent number. And the final result is a DCF, implied intrinsic value per share, and fully adjusted for the company's capital structure and potential dilution from all the money securities. So we have discussed per share value in detail, and we have also discussed about uh, fully diluted shares or convertible instruments, which could be stock options and warrants, and convertible bonds and preferred stocks. So for convertible bonds and preferred stocks, we use in if converted method, and for stock options and warrants, we use treasury method. So let's move to question number 5 now. So question number 5 now is about walk me through a DCF, dividend discount model that we would use in place of a normal DCF for financial institutions. Okay. And the mechanics are the same as a DCF, but when we use dividends rather than the free cash flow, so first thing is that we project out companies' earnings down to earnings per share first. Let me show you. We have discussed this in previous reading only. Okay. So if we are using a dividend discount model, you will not forecast the revenues, you will forecast the next year's dividend or next year's share price, earning per share, and you will assume a dividend payout ratio also, and what percentage of EPS actually get paid out to the shareholders in the form of dividend based on the firm that has historically done that. And then you will use these calculations of dividend for next 5 to 10 years and do a check to make sure that the firm still meets its target uh, capital ratios or tier 1 capital. If not, reduce the dividends. So every bank or a financial institution has obligations of maintaining a capital. So I'm assuming that this is an expected dividend, and on the basis of this, we have calculated the value of the share price of 50.25, 52.50. So if I assume that 40% is payout ratio, if I'm assuming that 40% is the payout ratio throughout the years, so what will happen is if 40% is the payout ratio, so I am only distributing 0.8, 0.84, and 0.882 as a dividend to my shareholders because to support the organization itself, they actually have a retention ratio. So out of retention ratio, so they are retaining 60% and they are only paying 40% to support their capitals. They are using retention ratio to support their capital. So this will dramatically change my valuation of the share price also. So dividend discount model. So let's get back to the question. So if just read this, and I think this is pretty much, I don't know, I would not need to explain it further. It will pretty much explain itself. So you will project the company's earning typically from EPS perspective for 10 to 5 to 10 years. Then you will assume the dividend payout ratio. How much dividend are they paying historically and in future also? So you will forecast on the basis of that. Then you will use that ratio and you will calculate dividend per share for the forecasted years. Then you will check if it's a financial institution, they have to maintain a certain amount of they actually have to certain ratio, they maintain certain ratios. So you will check that capital adequacy checks to make sure that given these dividend assumptions, the firm still maintains its required tier one and other regulatory capital ratios. Okay, let me just note it down so that in future I can make a video regarding this also. Capital adequacy ratio, financial institutions. And this will be helpful for you to understand. Okay, when we will be doing this sector experts series, we will be discussing about this in detail. So capital adequacy ratio, we will actually have to check, and after that, we will discount each predicted dividend back to the present value using the cost of equity, not weighted average cost of capital. Because in financial institutions, we have discussed that debt is considered as a part of operations. We will not be able to calculate free cash flows. And even if we do, we will be generating negative free cash flows. So that would be all wrong. And for terminal value, instead of perpetual growth method, we will apply price to book value multiple to the projected book value per share in a financial forecast in a final forecast year, which reflects how banks and insurers are typically valued in the market. I would then discount that terminal value back using the cost of equity. And finally, I'd assume present value of all dividends and the present value of the of terminal value to get intrinsic value per share. Okay, so I hope this was pretty much self-explanatory. And after the reading, after we have completed reading, just come to this reading question number 5 and read about it one more time. There is nothing, there is no new information here. We have discussed that previously that in financial institutions, DCF does not apply because uh, for DCF, we need to calculate the free cash flows. And here in banking institutions, free cash flows cannot be calculated properly because debt and interest expenses are actually a part of their operations. And also, debt is a considerable amount in these financial institutions. So we will not be able to calculate uh, free cash flows properly. We will not be able to justify our free cash flows. And also, dividend discount model makes more sense. We are forecasting the dividends, but also uh, banks come with a lot of regulations, rules and regulations imposed by the government. So there, capital adequacy ratios, we cannot distribute all our dividend payment. We cannot distribute all the dividends or all the earnings per share directly to the shareholders. So we need to also look into the adequacy ratios and how much retention or how what is the payout ratios and the retention ratios. And then we discount everything back using the weighted average cost, not the weighted average cost of capital, but the cost of equity, because one more time, debt is going to be a major considerable. So debt, because debt is not functional in debt doesn't normally function here in a conventional way. So we do not use weighted average cost of capital, we use cost of debt. This is a question which might be asked if you are interviewing yourself for an equity research analyst or investment banking analyst or in private equity or merger and acquisitions analyst, because this is actually very this thing is not available in the market freely. Valuing a bank actually is valuing a financial institution, valuing companies which are um, REIT sector companies. It's very difficult because they are not conventional companies. They do not behave like other companies. And understand this thing, dividend discount model is used for banks, and not only those, but we are not only this just dividend discount model, that's not only new, but you actually have to look into the government rules and regulations. If I'm interviewing you and if I'm asking you how do you value a bank, this should be your answer. How do you do a valuation of a bank? So you cannot do a DCF, you cannot do no other form of valuation. You can do a dividend discount model, and to some extent you actually have to do a dividend discount model by after looking into the other aspects also, capital adequacy, the government rules and regulations and all. Okay, so let's move to question number 6 now. I hope this we have covered everything here. So let's move to question number 6. When you're calculating weighted average cost of capital, let's say the company has convertible debt. Do you count it as a debt when calculating leveraged beta for a company? So when you are calculating weighted average cost of debt, oh, sorry, weighted average cost of capital, do you or do you not calculate leverage beta and consider convertible debt? So this is a great question, and it's actually a bit of tricky because the treatment of convertible debt in weighted average cost of capital depends on the conversion likelihood, and specifically whether it's in the money or out of the money at the time of the analysis. From a theoretical perspective, the goal when calculating weighted average cost of capital is to weight the required returns of each capital component, debt, equity, and any hybrids in proportion to the market values. A convertible debt is a hybrid security that with both debt-like and equity-like structures characteristics also. So its classification depends on economic substances rather than its accounting form. If the convertible debt is in the money, the market expects conversion into equity because conversion price is below the current share price economically. This means investors view the instrument as equity rather than as a debt. And in this case, you exclude the company's debt balance when calculating leverage beta or weighted average cost of capital. Instead, you treat this conversion as a source of equity dilution and increasing the company's equity value and share count. So practically, you would use the if converted method to adjust for dilution and re-estimating the company's equity value and capital structure accordingly. And if the convertible debt is out of the money, the conversion price is above the current share price. So conversion is unlikely. The, the instrument therefore behaves more like traditional debt and you treat it as such. So you would include it in the company's debt balance and use the uh, stated or effective interest rate to calculate the cost of debt. And the equity component in this case has negligible value. So, in summary, you actually need to the significant hinges on market conditions and conversion probability. So, if it's in the money, treat it as equity, dilutive portion, and if it's out of the money, treat it as debt and interest bearing. So, this approach aligns with the valuation best practices because weighted average cost of capital should reflect the current market based capital structure and not just the accounting classification, and ensuring the weighted average cost of capital accurately represents the company's blended cost of financing. So this was a very good question, and this was actually a very tricky question also to answer this. All right, so let's move to the final question, question number 7 of the discounted cash flow advanced series. So question number 7 is that we are creating a DCF for a company that is planning to buy a factory for $1,000 in cash, no debt or other financing in year 4. Currently, the present value of its enterprise value according to the DCF is 200,000. How would you change the DCF to account for the factory purchases, and what would our new enterprise value would be? So to understand this thing, to incorporate the factory purchase into the DCF, we actually need to account for the $100 cash outflow in year 4 as an additional capital expenditure. And since free cash flow is calculated as, so let me just show you. So what does a free cash flow looks like? So this is the free cash flow. So EBIT adjusted for tax rate, we add back depreciation, we subtract capital expenditure, and we subtract the changes in net working capital. So adding $100 in capital expenditure in year 4 actually will reduce our one, one, two, three, four. It will reduce our free cash flow. So we will be subtracting some hundred. If we will be subtracting $100 from 5750, so it will reduce our unlevered free cash flow by $100. So it will be 37301. Okay, so let me just take you to Excel. Where is our Excel? Here is our Excel. Media convention, we discussed about this. So if this is the year 1, 2, 3, 4, 38301. Okay, let me just check. Am I at the right year? 1, 2, 3, 4, 38301. Yes. 38301. Right now the terminal value is 374728. If I were to reduce $100 out of it to, this will reduce my free cash flow by $100. No, it will reduce the present value of, okay, this will reduce my free, I am reducing by $100. Let me just, let me just write it for quick comparison. 374728. This was the previous, this was the value without changing, adjusting for capital expenditure. If I am reducing $100, so this will be my new value. So my valuation has increased, sorry, decreased by about how much? It has decreased by $65. So conceptually, what we are doing is that we are actually adjusting the DCF to reflect that some future cash flows will be used to fund the factory rather than being available to investor. And this approach assumes that the factory does not generate incremental cash flow beyond that, beyond what's already included in the projection. And if the factory is expected to generate revenue or cost savings, then we would be incorporating as an incremental free cash flow in the relevant future years, which would offset or even exceed the initial outlay. So this is pretty much it. We will not adjust the valuation here, but we will adjust our cash flows and then we will discount it back. So this will change the present value, and this will decrease the present value, and that will further on decrease our enterprise value. So to the key analytical point here is to adjust it. To this adjustment is purely a timing or magnitude effect. It reflects the opportunity cost of the cash outflow and discount it to today, which is why we subtract the present value of enterprise value. This is why it will be subtracted from the present value of the enterprise value by $65.38, taking reference of this example, what we have. Okay. So I hope this was clear. This was helpful. here in the explanation also they have done is they have changed the how it will how much by how much it will reduce the enterprise value. They have given us a rough estimate of, but the formula wise the adjustment would be look this adjustment will look like this. And so the current enterprise value is 200. If the current enterprise value was $200, so we will reduce the changes and it will reduce whatsoever fraction. So we are lowering the company's value today, basically. Like previously in the Excel part, we have seen that 60 by 65%. And why I am using the Excel is to see if you are investing your time even half an hour, make sure that the half an hour is worth that. So you have learned something of value. So that's why we have used everything, every resource we have to understand these questions in detail. And I hope you have liked these videos. Uh, and so let's meet in the next session. We will be starting with merger and acquisitions series, and all the very best. And I hope you like these videos. Please subscribe to my channel. Thank you.